Now, it may be 2 days after his column, but we're midway through a rather dull trading week, so what better reason than to have Mark Barnes, Business Day columnist and chairman of Purple Capital, in studio. Mark, thanks very much for joining us.
Always a pleasure. Yeah.
So, Mark, your column, it had a slightly dull headline this week, I thought, but the substance of it was pretty interesting. And it was investing versus trading, I suppose, two aspects of managing your own wealth.
Yeah.
And the central message seemed to be, don't be scared to take charge of your own investments. Don't leave it to other people to manage.
Well, you see, you've got to keep up with the times, man. Way back when, you didn't even know what was happening to your assets. You know, you gave them to your dad's stockbroker, and then he would pay you out a stipend every 6 months, which you were meant to do when he felt like it, and you didn't really know what was going on. But now, we all know about equities. Equities are a part of our everyday life, everyone, and there are a number of reasons. The first one is we're all living too damn long. Okay, and that's got a lot of consequences. I mean, people now have to be married for 70 years. In the old days, you only had to be married for 20, and then one of you died, and you could move on. But anyway, so now you find that you work until you're 65 or 70 or whatever it is, and then you live for another 20 or 30 years. Okay. So one of the biggest financial parts of your life are actually managing money, not earning it. Okay, and that's a fundamental change. And if that's true, which it is, then you better start becoming involved in not being the default person in terms of when the markets go up or down, because they've been going up and up and up, so that's pretty cool. But I can tell you that the telephone calls will come when they go down at some point, and you'll phone your asset manager and he'll go, yeah, but they all went down. I mean, what's your problem? Well, you can have an impact on that, and if nothing else, you can understand it.
Yeah. Your point about being married for 70 years, which is a terrifying prospect, I suppose.
Yeah,
you also talked about your kids in the article, and you suggested that actually, if you were going to be a savvy investor, you'd get your kids involved. Do you think it's because they have a better idea of kind of the technologies of the future that will influence our lives?
Not so much. They have an open mind. Let's start with that. I can tell you now that there are some gold bulls that are in deep trouble.
Yeah, we have a few on the show.
Yeah, because they never change, okay? So, gold bull is a gold bull is a gold bull. I'm not even sure we've got any gold left here, but anyway. So, but your children come with this interesting open mind, and they go, Facebook, I can understand the economic multiplier effect. They're talking about a geometric progression in an underlying economic model without calling it that. So they've got an open mind, okay? But more important than having their opinion, I think, is exposing them to what the game's all about, because you do not look after your money until you have some. Most people don't have any money until the end. Okay, they don't. They're in overdraft, and they're betting with other people's money, and and they're having a go, and they're buying a house they can't afford. At some point, when your NAV turns positive, you start looking after them. Most of us don't get there. Okay,
yeah. And by then it's probably too late.
And by then it's too late to start the game. So if you give your children in the beginning an opportunity with 10,000 Rand or 50,000 Rand, whatever and see what they do, you will find them to be extraordinarily cautious. You'll find them to be extraordinarily considered, because it's the first time they've had to look after money that's theirs. And you will find that their insights are worth hearing. They'll see things different. They don't come with the baggage that we've got. They don't come with the preconditions, and they're not married to any market trends. So I think. But
have you given some of your money to your kids?
Yeah, of course, you know that, girls. Eh? Yeah, I have actually. Yeah.
And have they been managing them? What kind of returns have they been achieving?
Well, I don't want to turn them into asset managers, so I can't say that on the show. But I'll say. But going back to the adults now. There is not sufficient knowledge in one stockbroker or firm of stockbrokers' heads for that to define what you should or shouldn't be doing. A. B, I think we've all got preferences, and we all have the right to have exclusions and supercharges, if I could call it that. So if it is that you sit here and you go, look, I don't want to invest in sin taxes, I don't want to invest in, I think the retailers are overvalued, or either this or either that, you should have some interactive capacity which says, you invest my money, but by the way, I don't want to be in gold, or I want to be double in gold, or I want to be whatever. So within the ambit of your wisdom, sir, can you take notice of some of the things that I like or don't like? And can you leverage up some of these things and dismiss some of them? First point.
Okay.
Yeah. Second point is, when your manager does something, you should know about it. Okay. So in the modern world with technology, when he goes and buys Standard Bank shares, there should be a beep on your phone which says the guy just bought, and you can start thinking about what he's doing and become interactive with what, without advising him what to do. Because I can tell you why this is important. Because most asset managers have bias in them, and they do good, they do well when the bias is in their favor, and they do badly when not. So, fundamental gold bulls would have done badly in the last little while. Okay.
Do you think it's maybe we're getting to the stage where that bias and the kind of fees that asset managers have charged over the last few years will ultimately trip them up, where it's much more, well, you've seen the rise of the ETFs, and you did talk about it in your article, and most fund managers don't manage to beat the market, so just buy an ETF. But if you have kind of more technology at play, maybe the need for a fund manager reduces.
Look, I don't think they'll ever be eliminated as a need, because there are people that spend forever doing these analyses, and they know more fundamental stuff than we do. Okay, but there is a need to be able to pick and choose, and there is a need to foreshorten the time horizon of your decisions. Now, asset managers will tell you you must leave the money there forever. Well, of course they're going to tell you that. I mean, okay,
they've got some guaranteed income for the next
yeah, I mean,
20,
that's their
30
game.
years.
Okay, and markets generally do go up over time and so on. But I just think the game has fundamentally changed in the sense that I said earlier, in that it's not just your retirement. It's like half of your economic life that's at stake here. And the sooner you become educated about it, the better. I can tell you that the stuff that we do in finance is not clever, okay?
Yeah, you said you could explain a zero-cost collar option in 10 minutes.
Okay.
Maybe we can do that in the next show.
I promise you, give me a piece of paper and a pen, and I will draw you a future and a forward and an option and whatever, and you'll understand it. And because it's very simple stuff. And the benchmark is another challenge. So people go, well, if we outdo your deposit, as if that was the alternative, then we're going to charge. That's nonsense. I mean, that's not the benchmark. The benchmark is Satrix 40 or the JSE Top 40 or something. And so there's a lot of stuff which, as we become aware of it, we should become involved in it for a portion. I'm not saying go and manage all your money, because most people have got other things to do with their lives. But take 10 or 20% of it and do it yourself.
Yeah. Mark, you also make the distinction, and it's a clear distinction, although I think sometimes it gets blurred in people's own lives, between investing and trading.
Well, they're completely different things, okay? People who invest buy into something for the longer term, and they buy into it on fundamentals. Traders follow the stream, okay? A good trader, and I listed some of the rules that I've learned by my mistakes, because I'm not a good trader. I lose money trading, almost always, okay? Because I'm an investor, and I go, but this is not possible. I'm going to stay with this because I know it's going to go. Well, the guy who chops and changes because he's an intraday trader, he's got a different mindset. So he, as I said in my article, when it's going up, he buys. When it goes down, he sells. Respect the current. Don't, which is quite the opposite to asset management. Those two kinds of attitudes and mindsets very seldom find themselves in the same body. Okay, the guy who's the long-term serious investor is not the guy. In fact, they dislike each other with some intensity.
Yes, they do.
They have a huge disregard for one another. And I'm not saying that they should intersect, but more and more people are trading because they have access to technology, they have access to funds, which they then trade. I'm saying if you want to get into that set of rules, you must know that they're different to investing. You must know that they occupy an enormous amount of your mind space, because the information feedback loop is seconds. And I mean, if you get too involved in it, you can find that you've got your cell phone here and you're meant to be having a TV interview and you're checking the price. Right? So they're very different things, and it is exciting, and it's also got its own learning curves. One of the hardest learning curves about trading is the psychology of it. Okay. Now, if you can't deal with the fact that, because I've heard guys say, "You idiot! I mean, I knew that. I could have seen that it was going to turn." You can't have that. You've got to get to a peace with that.
And you've got to, yes, it's quite zen, and you've got to be
I'm above it.
Yes, you've got to stand back from it, and you make the points, because we're running out of time here.
Okay, sure.
But discipline.
Discipline. Stick to your rules. Make your rules. People lose money because they keep moving the rules.
Yeah.
So what they do is they take too much of their money and put it on one bet, and then they've got this much narrow opportunity for mistake, okay? And then they go, so it moves like this, and they go, I'm going to move it, I'm going to keep it, And before you know what happens, you've gone double or quits.
Yeah, and you're off the cliff.
And you're gone. And so you got to stick to, and the best traders I know, and I've dealt with many in the dealing rooms that I've headed up, and I still deal with many, good and bad. And the best guys know the rules, they stick to them, they're dispassionate, they know what they're doing. They're not trying to second guess the next fundamental shift in the oil price. They're trying to see what's happening and have a piece of it.
Okay, Mark, we have to leave it there,
Yeah.
unfortunately, but we'll chat again next week.
Cool.
Can't wait for your column.
Yeah.
That's Business Day columnist Mark Barnes, who's also chairman of Purple Capital.